Welcome to the Deep Dive. Today we're focusing on the Q3 2025 earnings call for KNOP Offshore Partners, or KNOP, an operator in the, very specialized shuttle tanker market.
And this was a really critical call. It happened right at the U.S. market open on December 5th. And, there's been months of strategic noise around the company.
We'll see about the sponsor, right?
Exactly. There were a lot of questions about the business model, especially with that buyout offer hanging out there. So these Q3 results, they were a decisive, and I'd say very loud, validation of their strategy.
So our mission today is to cut through all that noise. We're going to extract the most important financial metrics, what management's saying about this tightening shuttle tanker market, and of course,
The elephant in the room.
the status of that highly material buyout proposal.
Well, let's start with how the market reacted, because that tells you almost everything you need to know about how these results landed.
The tone was definitely constructive. I mean, the stock surged over 6% right after the call, almost hitting its 52-week high.
And why it was a massive beat. But we really need to focus on what that beat means, not just the raw numbers themselves.
Okay, so let's get the figures out there then.
All right. GAAP EPS came in at about 45 cents. The street was looking for something between 13 and 25 cents.
So a huge beat, more than double the high end of what analysts were expecting.
A massive beat. And on the top line, revenue was $96.9 million. Consensus was somewhere in the $86 to $90 million range.
That top line is really impressive. It represents something like 27% year-over-year revenue growth. But for me, the real story is in that net income swing.
Oh, absolutely.
They posted net income of $15.1 million for the quarter. Just compare that to the net loss of $3.8 million they had just 1 year ago.
That $19 million swing is the clearest signal you can get. It shows their commercial strategy is firing on all cylinders.
So let's dig into the quality of those earnings. What's under the hood?
Under the hood, you see validation of the whole business model. Adjusted EBITDA hit $61.6 million. If you run the math on that, you're looking at an EBITDA margin in the low 60s.
And that's the whole thesis, right? High margin, long-term contracts for mission-critical assets.
Precisely. And the fleet performance backs it up. They're holding steady at 19 vessels, but the operational utilization was just, exceptional. 99.9%.
99.9. That's practically perfect.
It is. And even if you factor in the scheduled dry docking, which is just necessary maintenance, utilization was still a stellar 96.5%. They're squeezing almost every possible dollar out of those ships.
But it has to give investors a lot of confidence in future cash flows.
It does, and that's where the backlog comes in. The fixed contract backlog actually grew after the quarter ended, up to $963 million. We're not just talking about today's cash flow. This is guaranteed security.
$963 million. Break that down for us. What does that mean in terms of years?
It gives them 2.6 years of average firm coverage across the entire fleet. And then you have all the charter options, which could add another 4.2 years on top of that.
So for a company like this, that kind of visibility just strips away a lot of the cyclical risk you see in the broader shipping sector.
It really does.
Okay, let's talk balance sheet. This is where the skeptics always look. On one hand, liquidity seems pretty healthy.
It is. It's sitting at $125.2 million. That's $77.2 million in cash and another $48 million they can draw on from their credit facility.
And what's really key is they actually built liquidity this quarter, right? By about $20 million. They're retaining cash.
That's the good news. The challenge, and it's still a challenge, is the leverage. Total debt is high. It's almost $1 billion.
At $986.5 million. That puts their net debt to EBITDA ratio at around 3.9 times.
Which is high for a partnership structure, no question.
So how did management address that? What's the plan to tackle that debt pile?
They were very direct about it. They're committed to aggressive debt reduction. The guidance they gave was for paying down $90 to $95 million per year.
Per year. So if they can actually execute on that, that leverage ratio will come down pretty quickly, even if EBITDA just stays flat? Exactly.
It's a deleveraging story powered by operational cash flow. And they also pointed out that the margin on their floating rate debt is pretty low, about 2.22% over SOFR, which helps keep their interest payments manageable.
Okay, that makes sense. A manageable burden for now. Let's pivot to the strategic moves because they were very busy this quarter beyond just managing liquidity.
Oh, very busy. But the single biggest item, the one everyone's watching, is that unsolicited offer from the sponsor, KNOP, to buy all the public units for $10 cash.
And management's official line is that they're bound by the public filings But the real work is happening with the Conflicts Committee.
Right. An independent committee, which is key. They've hired Evercore and Richards Layton to advise them, so you've got serious firepower looking out for the minority shareholders.
And while that's going on in the background, the team was making some very smart moves with their assets.
They were. They acquired the Dacking Knutson from the sponsor, and it came with a guaranteed 7-year high-rate charter. That's an immediate boost to future contracted revenue.
And then on the other side of the coin, they did a sale-and-leaseback on the Tove Knutson.
A very smart capital recycling move. It unlocked about $32 million in net proceeds. That's the kind of financial engineering you love to see generating cash without hurting operations.
And that cash helps with their refinancing efforts.
For sure. They got a new $71.1 million term loan for one vessel, the Synnøve Knutsen, and they rolled over 2 separate $25 million credit facilities. The goal is clearly to push out their debt maturities.
We also saw more proof of that tightening market with charter extensions.
Yes, very important ones. They extended the Hilda Knutsen with Shell and the Bodil Knutsen with Equinor, locking them in firm through March 2029, plus options.
And there was a new charter for the Fortaleza Knutsen starting in 2026.
Right. These aren't just minor tweaks. This is tangible proof that customers are competing for these specialized vessels and locking in rates.
This brings up an interesting point about the buyback program. They were buying back units at around $7.87.
They were. They used about $3 million of a $10 million authorization, but then pretty abruptly, they terminated the program in early October.
Just before the sponsor's bid arrived.
The timing is, let's say, highly suggestive. It's a move that sort of preserves the sponsor's negotiating room. It makes the whole conversation around that $10 bid much more complicated.
So let's connect all these micro results to the bigger picture. When you look at KNOP's performance versus the market, what do you see?
You see a complete outlier. The stock is up nearly 89% over the last year. The S&P 500, maybe 17 or 18%.
So this isn't just a case of a rising tide lifting all ships.
Not at all. In fact, the broader shipping ETFs are basically flat, low single-digit returns. This outperformance is all about KNOP's specific story, the turnaround, the deleveraging, and, the M&A optionality.
And that story is built on a solid industry foundation. The CEO, Derek Lowe, kept talking about winter 2025 operating momentum. What's driving that?
It's new oil fields coming online, specifically these big FPSO projects, floating production, storage, and offloading units. You're seeing them start up in Brazil, with Petrobras leading the charge, and also in the North Sea.
And those massive offshore platforms need these specialized shuttle tankers to get the oil to shore.
They absolutely do. And here's the kicker from management's perspective. The supply of these tankers isn't keeping up.
The classic supply-demand imbalance.
Exactly. Lowe stated pretty clearly that the current order book still trends towards a medium-term shortage of shuttle tankers. You can't just build one of these overnight. So that structural shortage is what's going to support high rates for the foreseeable future.
Which brings us back to the buyout offer. The stock is trading at $10.72 post-call. That's a solid 7% premium to the $10 cash offer.
And that premium is the market screaming that the sponsor's initial bid is too low. It's a clear signal.
So the market thinks one of two things is going to happen.
Right. Either the sponsor sees these strong results and sweetens the bid, or the company is just fundamentally worth more than $10 on its own, even if no deal happens.
That $10.72 price is basically the market pricing in a higher outcome.
It is. The strong quarter gives the Conflicts Committee a ton of leverage in their negotiations. They know what the street knows now. $10 doesn't cut it.
This is the perfect transition to our required segment. This is not financial advice. We are not recommending any course of action, but we are going to construct an outrageous but plausible trade idea based on everything we've just discussed.
Okay, so let's pitch it like an analyst would. You have this massive operational beat. You have nearly $1 billion in revenue visibility, a clear path to paying down debt, and a market that is structurally undersupplied. The $10 offer looks stale.
So the idea is to capture that disconnect. Walk us through the trade structure.
I think you initiate an event-driven trade. You go long the common units, KNOP, at today's price of $10.72, and you combine that with a moderately out-of-the-money call option, maybe targeting a $12.50 strike price.
And what's the logic behind combining the stock and the option?
The beauty of it is the defined risk. Your downside is sort of floored at $10, which is the announced cash bid. If the committee just accepts that offer, you take a small, manageable loss from $10.72.
But the upside comes from two potential scenarios.
Two scenarios. First is the sweetened bid. The committee holds out, the sponsor comes back with, say, $11.50 or $12. You make a profit on your stock, and your call options become very valuable.
And the second scenario, what if the sponsor just walks away?
That's the walkaway scenario. If there's no deal, the stock then trades purely on its own strong fundamentals. With management paying down $95 million in debt a year, the company de-risks itself rapidly. That alone could justify a higher multiple and push the stock towards that $12 range anyway.
So the trade leverages a clearly defined floor with two separate paths to a higher valuation.
Exactly. It's a classic event-driven thesis.
Okay, to wrap this all up for you, the listener.
Yeah.
The key takeaways from this deep dive are: 1, a massive earnings beat that validates the entire shuttle tanker model. 2, significant de-risking moves on the balance sheet. And 3, this ongoing tension between the $10 offer and market fundamentals that are screaming for a higher price.
The whole narrative has shifted. It's no longer about survival, it's about strategic offense. They've proven their value. But I'll leave you with one final provocative thought.
Go on.
The company's annual meeting is scheduled for December 15th. The CEO couldn't comment on the buyout timeline, but think about this. What if the Conflicts Committee recommendation is delayed until after the new independent director is officially seated on the board?
A delay could be a signal.
It could be a very deliberate signal, a way of saying they want even more leverage and independence before they make a final decision on that buyout price. It could really raise the stakes.
Something to watch for. We definitely encourage you to review the official filings. And thank you for tuning in to this deep dive. We'll catch you next time.